You've probably heard people say real estate builds wealth, but what does that actually mean? What kind of properties and what kind of returns, and how do you even get started? Welcome back to Inside the Industry, where we break down different industries so you can understand how they actually work, and more importantly, how people make money in them. Today, we're diving into one of the most talked about wealth building strategies out there: owning a real estate portfolio for rental income. Cue the intro. I'm Jake Tobin, a licensed business broker at Transworld Business Advisors, and I work directly with business owners in navigating exits, growth decisions, succession planning, and acquisitions. To start off, let's outline what makes this industry so attractive and popular for people looking to multiply their income stream. First, you have cash flow. This is the difference between your rental income and your monthly expenses, such as your mortgage, your taxes, the insurance, and maintenance. If structured correctly, you should be getting paid every month. Second is appreciation. Over time, properties tend to increase in value. So while the tenant is paying down your mortgage, the asset itself is growing. Third, your tax advantages. Real estate owners can benefit from depreciation, write offs, and other tax strategies that can reduce the taxable income. And fourth, arguably the most powerful, is leverage. You're using the bank's money to purchase a large asset. A relatively small down payment can lead you to growing your real estate portfolio. So you're earning income, you're building equity, you're getting tax benefits and benefiting from appreciation all at the same time. And that's why this industry is so attractive. When we talk about a real estate portfolio, it's not just a single family home. There are several different property types investors focus on. You do have residential, which can be single family homes, duplexes, triplexes, maybe even small apartment buildings. But you also got short term rentals, such as Airbnb style properties. But then you have your special assets, the mobile home parks or the manufactured homes. Each comes with different risk profiles, tenant types, and return expectations. Now, let's talk about the operational side. You're not just collecting rent, there should be systems in place to maintain your properties and manage the tenants. Now, with every property, you need insurance. You'll typically need landlord insurance, liability coverage, and sometimes additional policies depending on the asset type. Here in Florida, you need hurricane, wind, and flood, just to name a few. You have to review your contracts and agreements that are in place, your lease agreements, the property management agreements if you're not self managing, and any vendor contracts for maintenance, landscaping, or repairs. Now, on the management side, you can either self manage or hire a property manager. That's a key decision. Do you want passive income or are you willing to be hands on? This is where real estate starts to look less like easy money and more like a business, because that's exactly what it is. So, how does someone actually get into this space? Step one is understanding your buying power. Talk to lenders and understand what you can qualify for and what your realistic budget is. Step two, you need to start small and start smart. A lot of investors begin with a single family rental, a duplex where they live in one unit and rent the other, or a small multifamily property. Step three, analyze deals properly. You need to understand cap rate, which is the measure of the property's potential earnings, the cash on cash return, vacancy, and repair and maintenance costs. Step four, build your team. You will need people that are reliable and supportive of your goal. This can include your real estate agent, a lender, a CPA, and possibly a property manager. And step five, think long term. This isn't a flip, it's a portfolio strategy. The real wealth comes from holding and scaling over time. Now, let's flip perspectives because this is where it gets really interesting from a business brokerage standpoint. At a certain point, owners look to sell part or all of their portfolio, which can be to retire or maybe they need the liquidity for another property. What does that look like? First, portfolios are often valued based off of net operating income, cap rates relative to the market, your tenant stability and lease terms, your property condition, and location. For buyers, they're not just buying properties, they're buying income streams. A well structured portfolio with strong tenants, long term leases, consistent cash flows can be extremely attractive and command a premium pricing. On the flip side, portfolios with high vacancies, deferred maintenance, poor management may still sell, but at a discount. For sellers, preparation is key. Clean financials, organized leases, maintenance records, clear operational structure. This turns a property sale into a true business transaction, which opens the door to many more qualified, sophisticated buyers. Real estate isn't just about owning property. It's about building a system that generates income, appreciates over time, and can ultimately be sold as a valuable asset. Whether you're looking to start your first deal or eventually exit a portfolio, understanding how this industry works gives you a major advantage. If you're thinking about buying, selling, or even just figuring out if your portfolio is structured the right way, I'm always happy to start the conversation. And if you got value from this, make sure to like, subscribe, and follow along for more episodes of Inside the Industry, where we make deals simple.